Have you noticed that everything seems more uncertain lately? Inflation remains a concern. Interest rates are still affecting consumers and businesses. Stock markets are reacting to economic data, and geopolitical tensions around the world continue to create uncertainty. So what could all of this mean for your money? In this video, we'll break down what's happening, what could happen next, and most importantly, what everyday investors can do to prepare without panic. Welcome to the Simply Speaking About Money video channel. It is here where we talk about budgeting, saving, and investing in the real world of probabilities, and not the crazy hype, noise, and lottery-like promises of possibilities. Stay until the end, because we'll discuss practical steps you can take right now, regardless of what happens next. One thing investors often forget is that markets dislike uncertainty more than bad news. Bad news can be priced into markets. Uncertainty is much harder to price. That's why markets often react sharply when geopolitical events occur. Wars, trade disputes, sanctions, shipping disruptions, and political conflicts can affect economies around the world. When global trade becomes disrupted, prices often rise, and when prices rise, inflation can become more persistent. Inflation is simply the general increase in prices over time. When inflation rises faster than incomes, purchasing power declines. Many people think inflation only affects groceries and gasoline. In reality, inflation impacts nearly every aspect of daily life: housing, healthcare, insurance, utilities, travel, and retirement expenses. Even moderate inflation can significantly reduce purchasing power over long periods. That's why investors pay close attention to inflation trends. Central banks typically respond to inflation by raising interest rates. Higher rates are designed to slow spending and reduce inflationary pressure. But higher rates create challenges of their own. Borrowing becomes more expensive. Consumers spend less. Businesses invest less. Economic growth can slow. This creates a balancing act. Fight inflation too aggressively and economic growth may suffer. Act too slowly and inflation may remain elevated. Investors are constantly trying to predict which outcome is more likely, and that's where market volatility often begins. Now let's talk about stock markets. Markets are forward-looking. They care less about today and more about expectations for tomorrow. If investors expect economic conditions to improve, markets often rise before the economy fully recovers. Likewise, markets can decline before economic problems become obvious to everyone. This is why waiting for perfect clarity rarely works as an investment strategy. By the time certainty arrives, markets have often already moved. Geopolitical tensions add another layer of complexity. Conflicts involving major economies can affect energy prices, trade routes, and investor confidence. For example, disruptions in global shipping can increase transportation costs. Those costs can eventually reach consumers. Energy markets are particularly sensitive to geopolitical events. Changes in oil and natural gas prices can ripple throughout the global economy. Higher energy prices often contribute to inflation pressure, and inflation pressure can influence central bank decisions. This creates a chain reaction that eventually affects stocks, bonds, housing, and consumer spending. The challenge is that nobody knows exactly how events will unfold. Not economists, not market analysts, not financial television personalities. Despite what some headlines suggest, nobody has a crystal ball. If they did, they probably wouldn't be selling predictions online. This is why successful investing relies on preparation rather than prediction. If you're finding this helpful, please take a moment to like the video and subscribe. It helps the channel tremendously and allows us to continue creating practical, beginner-friendly financial education. Now, let's continue. So, what should investors do during uncertain times? First, avoid emotional decisions. Fear and panic rarely improve investment outcomes. Second, maintain appropriate diversification. Diversification doesn't eliminate risk, but it can reduce concentration risk. Third, continue investing according to your long-term plan whenever appropriate. Many investors accidentally buy high and sell low by reacting emotionally. History shows that markets have recovered from wars, recessions, inflation shocks, financial crises, and countless geopolitical events. That doesn't mean declines aren't painful. It means recoveries have historically followed downturns. Investors who remained disciplined often benefited from those recoveries. Investors who abandoned their plans frequently struggled to catch up. One lesson repeats throughout market history. Temporary events often feel permanent while they're happening. But many crises that once seemed overwhelming eventually became chapters in financial history books. This doesn't mean investors should ignore risks. It means risks should be managed rationally. Your emergency fund becomes especially important during uncertain economic periods. Cash reserves can provide flexibility and peace of mind. Debt management also becomes more important when interest rates remain elevated. Reducing high-interest debt can improve financial resilience. Investors approaching retirement should carefully review asset allocation and risk exposure. Younger investors may have more time to recover from market declines. Retirees often face different considerations. Every investor's situation is unique. That's why personal financial planning matters. The future will almost certainly include surprises. Some positive, some negative. That's normal. What matters most is having a plan capable of handling uncertainty. Because uncertainty isn't an exception to investing. It's a permanent feature of investing. The goal isn't predicting every market move. The goal is building a strategy that can survive many market environments. Inflation, market volatility, economic uncertainty, and geopolitical events will continue to create headlines. If you found value in today's video, make sure you hit the like button and subscribe to Simply Speaking About Money so you never miss practical strategies that help you build wealth and make smarter financial decisions. Also, check the description box below for the financial tool we recommend related to today's topic. It's a resource we personally suggest because it can help you apply what you've just learned and take action immediately. Your support helps this channel continue bringing you clear, no-hype financial education. Now stay with us, because up next is a special bonus that can help you take this even further. If you want to see your entire financial life in one place, clarity is the first step. That's where Empower comes in. Empower gives you powerful tools to track your net worth, monitor investments, analyze fees, and plan for retirement, all in one dashboard. You can connect your accounts, see exactly where you stand, and make smarter decisions with real data, because what gets measured gets managed. If you're serious about organizing your money and building long-term wealth, check out the link in the description to explore Empower. Affiliate disclosure: I may earn a commission if you sign up using my link at no extra cost to you.